Okay, folks. I think I will ask the question for the last time, and then I would stop nagging you. How many of you have not picked a company yet? Notice how I phrased the question differently this time. How many of you have not picked a company yet to value? Okay. I'm not going to jump down your throat. I just want you to pick one soon, right? Don't hold off much longer because we're 6 sessions in. So today I want to continue our discussion of equity risk premiums, and in particular I'm going to introduce an alternative to the way in which most people estimate equity risk premiums. Do you want to remind me again, what did we talk about? How do most people estimate equity risk premiums?
They look at
Past, right? Look at historical risk premium. Last 50 years, last 100 years. What's wrong with doing that? First, it's backward looking rather than forward looking. Things could have changed. Second, it is noisy. Remember the standard error. And third, if you have a market like Vietnam, you can't even do it, right? It's just not there. So today I'd like to offer you an alternative. And when I do it, it's going to sound, look fancy. But I'm going to set up the intuition behind what I'm going to do by setting up a very, very simple example. So I'm going to pick one of you. So let's say you're going to be my guinea pig, okay? Let's say you are looking at an investment where you're guaranteed $1 a year, every year, in perpetuity. And don't come back and say, I'm not going to live in perpetuity. Your children, your grandchildren, your great-grandchildren get it, and you're optimistic about the world not blowing up. Okay? $1 a year in perpetuity. How much would you pay for this investment today?
about 50 bucks.
Okay? When you pay $50, you're essentially settling for how much is the risk-free rate?
2%.
Are you okay with that?
Um,
What can you? Yeah, so literally, you'd ask for more. You'd pay more. That'll make it even lower. Remember, what's the T-bond rate right now? 4%. So no, we're looking at 4%. So you essentially, if that is risk-free, I would say 25, right? So in a sense, because it's guaranteed, you're going to pay $25, and if you pay $50, you're effectively getting 2%. If you pay, the more you pay, the lower your return is. So let's file that away. What you pay is telling me a little bit about your expected return here. Now let's extend the idea since. Now let's suppose I gave you the same investment, but this time you're getting $1 a year every year, but it's not from a guaranteed investment, but from a risky investment, about as risky as the average risk stock. So you see the difference, right? He was willing to pay $25 for a guaranteed investment and accept a return of 4%. Would you pay less or more?
way less.
Way less. Okay, give me a number.
Let's say 10.
Okay, if he says that he's willing to pay $10 for this investment, has he given away his expected return on this investment? What's his expected return going to be? 1 divided by 10, 10%. You've given away your equity risk premium, right? 6% is your equity risk premium. Do you see what I'm saying? If you tell me how much you pay for things, implicitly you're telling me what your risk premium is. And that is the insight we're going to use today to break out what the equity risk premium for the market is. Do we know what people are willing to pay for stocks right now? Yeah, there's a price out there. I can look at the index. Do we know what the expected? Okay, we don't, but we can estimate what the expected. It's not going to be as simple as this $1 a year every year, but I can give you what the cash flows are. And I'm going to solve from those numbers what your expected return is. And use that to get an implied equity risk. Implied because it's implied in the prices. Now, what drives the equity risk premium is how risk averse you are, right? So as I talked yesterday about, or Monday, about how as you age, risk premiums go up. Lots of different reasons. You got responsibilities, you get older and wiser or more scared, whatever it is. But there is evidence that is people. There's also evidence that risk premiums vary based on whether you're male or female. I know we're entering dangerous territory here. But are men more risk averse than women, or women more risk averse than men? It depends. Young men are less risk averse than young women. I can attest to that. I have 3 boys and a girl. They're all grown up now. I always could sleep, and my daughter took the car out. My sons had to stay awake till they got home. Young men take not just less risk averse, they take some really bad risks. Okay? In fact, a few years ago when Societe Generale had this huge trading scandal, there's some trader lost like 5 billion. I made a suggestion. Have any of you guys been in a trading room of an investment bank? You look around. There's a disproportionately large number of one subset of people. Young men, right? If you were going to create a group of bad risk takers, this would look like it, right? Put young 25-year-olds in front of the God knows what kind of risk. So I made a suggestion that people didn't take seriously. I said there's a very simple check on bad risk taken by this group of people. The only person who can check a 25-year-old or 23-year-old male taking bad risks is his mother. So I suggested that they hire every trader's mother, pay them $100,000 to sit behind the trader, look over the shoulder. What are you doing now? That looks really risky. Don't do it now. You're saying that'll cost us a lot of money, but you'll save it there will be no $2 billion trading loss if your mother's standing behind you, sitting behind you saying, don't do that. There's clearly an effect as people age, that risk aversion. And we talked yesterday, Monday, about the demographic bomb that is going to go off. It's already gone off in Japan and Europe. That might potentially go off in China. You know what this implies for equity risk premiums then, right? If people are getting older, investors are getting older, equity risk premiums are going to rise. If equity risk premiums rise, what does that do to stock prices? They're going to go down. There is a long-term push towards lower stock prices in countries with aging populations. So let that all filter in, because it effectively means equity risk premiums are this dynamic number that are affected by everything happening around you, and they're going to play out. So let's go back to where I left you. The notes we're talking about, I left you with the, emerging market exposures and how to estimate it. There's one thing I did not mention, which is, we talked about how to estimate the equity risk premium for a company, and I said you could use revenue weights, you can use production. For oil companies, I said, look at where you get the oil. But in both those approaches, I'm trying to get the equity risk premium as a weighted average of where you operate. There's another approach, and I use it very infrequently. I'll tell you what kinds of companies this would be. Where if a company has an exposure in one risky country, and I want to focus in just on that country, rather than bundle it together like I did for Embraer and put it into the equity risk premium, I leave that country risk premium separate, in the case of Embraer for Brazil, and estimate how exposed the company is to that country's risk. I concocted a measure called Lambda. Notice the word I use, concocted, doesn't derive, no deep thinking involved, called Lambda to try to capture that risk. So why do you call it Lambda? Discovered that if you attach a Greek alphabet to things, it adds a layer of sophistication that people don't want to push back against. Why do we call betas betas? Why not B? But betas, you feel there must be something magical behind it. A Lambda measures your exposure to country risk. And here's how it works. If you believe in the Lambda approach, you're trying to, a high Lambda means you're more exposed to country risk. And here are some of the things that might affect your Lambda. And you can add to this list if you want. The first is whether you use risk management products. There are some companies that use insurance, derivatives. You could lower your Lambda by doing that, so I want to know what you do. The second is if you're a company viewed as being in the national interest, God help you, your country risk just went up. Because it means the government has a very direct interest in how you run. So I'm going to look at that. I'm also going to look at where your revenues are, everything I looked at for my traditional calculations, but now I'm focused on getting this Lambda. A Lambda looks very much like a beta. Lambda 1 means you're as exposed as the average risk company in that market to risk. A Lambda less than 1 means you're less exposed than the typical company in that market. A Lambda above 1 means you're more exposed. So I'll give you my most simplistic way of estimating Lambda. I talked about Embraer in the last class, Brazilian aerospace company that gets almost all of its revenues outside Brazil. So I gave you the intuition. Embraer should be less exposed to Brazilian country risk than another Brazilian company that gets most of its revenues from Brazil. In this case, I'm going to pick the other end of the extreme, a company called Embratel, a phone company in Brazil that is absolutely completely locked into Brazil as a country. They can't even leave. There are regulatory requirements. So you have two extremes here. Embraer that gets 7.62% of its do I have Embraer? No, sorry. I've used Tata Motors and TCS, but you can use Embraer and Embraer. I'll stay with that. Embraer got about 3% of its revenues from Brazil. Embraer got 100% of its revenues in Brazil. The Lambda for Embraer was like 1.7. The Lambda for Embraer was like 0.04. Basically reflecting just revenues. Here I've taken another pair of companies from India, TCS, which is part of the Tata family group, but it's a outsourcing company that gets 7.6% of its revenues in India, and Tata Motors, which gets 91% of its revenues in India. Both Indian companies, but the Lambda reflects the fact that one company gets very little. Generally, the Lambda approach, as I said, I use only because if I have 72 countries and I have to estimate 72 Lambdas, I'm going to go crazy. So for companies with lots of country exposures, go with the approach I talked about in the last session. Take a weighted average of where this company does business, either with revenues or production. But if you have a company with a single country you're worried about, whether it's Turkey, Nigeria, and you want to think about Lambda more seriously, that thinking can, I think, give you insights into the risk you worry about in this specific company. Okay. One final point about Lambdas, if you don't know, the revenue thing is a very simplistic measure. There's actually a market-based measure of Lambda that you can try. You know how we estimate betas, right? We run a regression of stock against a market index. The slope of the line is the beta. It measures how much your stock moves relative to the market. You can actually estimate Lambda by looking at a traded instrument. I'll take Brazil as an example. Brazil's country risk ebbs and flows. And there are country bonds issued by Brazil. The dollar-denominated bonds that are traded. And you know what drives those bonds? Partly what happened to US dollar interest rates to begin with, because the other is country risk. Every time country risk increases, that Brazilian dollar bond rate goes up. So in this graph, here's what I did. I took the Brazilian dollar bond and ran a regression against Embraer. So if you look at, there's Embraer, there's a return. So basically, I'm taking the return of the stock running against the dollar bond. So if I have a company that's exposed to country risk, you should see its stock react much more to what the dollar bond is doing because it's more sensitive. So the slope of the line, like I did for beta, becomes the lambda for the stock. For Embraer, that lambda was 0.27. What does that tell me? Embraer is not that exposed to country risk. For every 1% increase in the dollar bond, there's only a 0.27% increase in Embraer. In contrast, Embraer, the phone company, every 1% change in the Brazilian dollar bond translates to 2% change. It's much more exposed to country risk. So in periods where country risk is dropping or increasing, you're going to see companies like Embraer less affected than companies like Embraer. And you're going to see this play out across an emerging market. So I tend to look at exposure rather than where a company is incorporated. But I'll concede, most people out there, most investors, most analysts still think about country risk through the lens of where you're incorporated. Brazilian companies, Brazilian country risk. Now remember what we said about intrinsic value, you've got to take a stand. The stand is, should I do what everybody else is doing because that'll get me closer to the truth, or do I believe that this is closer to what drives intrinsic value? I firmly believe that an intrinsic value, it's where you do business that drives country risk, not where you're incorporated. So let's say you go along with that belief, you buy into it, see, that makes sense to me. I'm going to ask you a question about what kind of investment strategy you can then develop based on that view of the world that will allow you to make money. So we'll play that out. So start thinking about it. If I believe that investors are wrong in treating all Brazilian companies alike, how do I then take advantage of that market mistake? We talked about taking advantage of market mistakes. Because the approaches can give you very different numbers. In this page, I've actually taken Embraer and computed 5 expected returns. Remember, these become hurdle rates to use, all in dollars. All start with the same risk-free rate. So that is the US dollar risk-free rate. In the first approach, I basically treat it as just another Brazilian company. And I attach the entire Brazilian country risk premium to it. And I come up with a cost of equity of 17%. In fact, if you take these 5 approaches and you group them together, in any approach where I treat it as just another Brazilian company, I get 16, 17, 18% as my discount rate. In any approach where I treat them as a company with a lot of exposure in developed markets, I come up with 10, 11% cost of it. Play it out. Right? Let's assume everybody else is using 17%. Let's say everybody's doing discounted cash flow valuation. and everybody's using 17% discount rates to value the company, and you use a 10% discount rate, what are you going to find? You're going to find that the stock is significantly undervalued, right? Because people are going to push the price down, and you think that's unfair. You shouldn't be punishing this company for being another risky company. You ready to set up your investment strategy? So help me out. If you apply the strategy out, what are you going to do to find your stocks to buy? What are you going to do across the world? You're going to go to the riskiest emerging markets. Let me get you started. What type of companies in those markets are you looking for? Which are the companies in those markets which get most of their revenues outside the markets. So to be Embraer in Brazil, TCS in India, Vinamilk in Vietnam, basically companies that are in that country but get a lot of their revenues outside the country. And don't be too quick and jump in right now, because remember, you need to make money. What has to happen? Everybody has to come to their senses, right? Saying, how do I do that? Who knows? Wait for a crisis. You think, will there be a crisis? It's an emerging market. Of course there'll be a crisis. It's a question of when, not whether. Wait for a crisis, because in a crisis what happens? Everybody sells everything. They push prices down across the market. Buy Vinamilk, TCS, Embraer, and then hold and pray. Pray that what happens? That eventually the truth will come out. The way the truth comes out is the country gets into trouble, but this company keeps reporting earnings that look good, and at some point in time, investors wake up. I bought Embraer in 2002 or 3. I don't know if you remember the first time Lula ran for election in Brazil. People basically said he's a socialist, everything's going to be private, he's going to nationalize everything. Brazilian stocks lost 40% of their value, including companies like Embraer. And I said, that doesn't make sense. There's country risk, but this is a company that gets 97% of its revenues outside Brazil. Yeah. And that had a good ending. Sir, there are other stories I could tell you which had bad endings, but if you believe that risk comes from where you do business, there is a way you can monetize that belief. And that's what I want you to think about in intrinsic value. Think about the right thing to do. Think about what everybody else does. You will feel the urge to do what everybody else does. I don't want to be the outlier here. And if you go to work at a bank, do what everybody else does. Why do you want to make life difficult for yourself? It's not your money anyway. But if it's your money, you want to take a stand on things you think matter. And I think this is something I think we need to take a stand on where risk comes from. Conversely, if I can sell short, you know the companies I would sell short on? US companies and European companies that get what? Most of their money from emerging markets, because I know there will be a crisis, and then these companies will wring their hands and say, oh my God, I never saw this coming. And you say, I saw that coming because you had 60% of your revenues in Afghanistan. What did you think would happen, right? So this is about using common sense. A risk comes from where you do business, not where you're incorporated. You'll see companies do all kinds of contortions because of the way analysts treat risk. I remember a South African mining company, and they decide to delist in Johannesburg, which is where they were listed, and relist in London. And I said, why are you guys doing this? He said, because we want country risk to go away. I said, it's that easy? What do you plan to do next? Take those mines out of South Africa and put them in the middle of Lancashire? All your risk is still in South Africa. Putting your listing in London doesn't make that risk go away. But people look for these cosmetic things. They think that that takes risk because of the way analysts think about risk, where you're listed. Alibaba was listed on the NASDAQ. It's a Chinese company. When you value Alibaba, you'd be crazy to be using the US equity risk premium to value Alibaba. So let that kind of, so think about it. You might not agree with the way I've estimated country risk premiums, but if you agree with the way of thinking about country risk is coming from where you do business, that's a win as far as I'm concerned. Any questions on country risk and how to bring it into your company's valuation? So I'm just finishing the valuation. Yesterday I was in CNBC and the guy mentioned the MAG 7. That's the name they've attached to the 7 stocks that carried the market for much of the year. So that includes, Facebook, Amazon, Netflix, not Netflix, Facebook, Amazon, Apple, Google, and who am I missing? NVIDIA and Tesla were the 2 add-ons, but the original out of the FANGAM, everybody but Netflix. But So he called them the Mag 7. So I decided I wanted to value each of the Mag 7. That might be your next valuation of the week, is you can pick any one. I'm going to value all 7. And I was valuing NVIDIA. And this was the question that I got stuck on. NVIDIA is a US company, but it's a global chip company. Its revenues, it gets all over the world, but all of its production comes out of Taiwan Semiconductors. NVIDIA doesn't make a single chip. People don't even realize it. They design the chips. TSMC makes the chips for them. And I was thinking about, how do I bring in country risk here? Because I am getting China risk in NVIDIA no matter how I dance around this, and that has to be in my valuation. That's what I wanted to start thinking about, is where does my company make its stuff? Where does it sell its stuff? How do I bring that risk into my discount rate? Okay. So now let me set up this process of thinking about equity risk premiums, because I'm not satisfied with my starting point. If it's a historical risk premium, I'm already shaky, right? Plus or minus 4% in either direction, that's not a good place to start. So in an implied equity risk premium, here's what I'm going to do. I'm going to borrow from how we think about expected returns in the bond market. Remember in your foundations class, you learned how to price a bond? Okay. You also probably learned about yield to maturity on a bond. I want to test you on how much of your foundations you remember. How do you compute the yield to maturity in a bond? Do you want to tell me how would I go about computing the yield to maturity in a bond?
In terms of calculating the yield to maturity, I'm pretty sure it was.
I'll get you started. You have the price of the bond, right? What else do you know in a bond?
In terms of,
What are your cash flows in a bond?
yeah, you have the cash flows for essentially here, and then in order to calculate the yield to maturity, you essentially just do cash flow over.
That's a yield on a bond. The yield to maturity is a little trickier, right? You're close on that. You take the coupon, which is fixed, and the face value. The yield to maturity is?
You take the price and then the cash flows, and then you take the right discount.
You solve for a discount rate that makes what? The present value of the coupons and the face value. It's an internal rate of return for a bond. Right. We do this all the time with bonds. It's a forward-looking number, and if the bond gets riskier, what happens? The price drops, the yield to maturity goes up. That's how we've always done bonds. And I remember in the mid-90s saying, why can't I do this with stocks? Let's play it out. Instead of buying a bond, I'm now buying the S&P 500. That's the price. Instead of coupons, what do I hope and pray I will get as cash flows on stocks?
Sorry.
What are the cash flows I get on stocks? I don't get coupons. What do I get instead? Dividends, and in the US increasingly buybacks. And unlike a coupon, which is a fixed number, dividends and buybacks could change over time, so I make estimates of what they will be in the future. And after I've done that, I've got something that looks just like the bond pricing equation. I have the level of the index, I have the expected cash flows, and I solve for that discount rate that makes the present value of the expected cash flows equal to the level of the index. Trial and error, I can get there. That is a forward-looking expected return. So tell me what's going to happen if the market drops by 20%. You're going to see the expected return go up, just like in a bond price and interest rates. Every time the market moves, your expected return is changing, which is the way we want it to be, right? It's dynamic. So here's what I'm going to do. I'm going to take you to the start of 2020. And there's a reason I'm going all the way back. This was in those innocent days when we didn't know pandemics could shut the whole world down. So it's a pre-COVID start of that year. January 2020, the S&P 500 was at 3231. So I bought the index. To get my expected cash flows, I start with what I knew, which was the cash flows I got in the last 12 months, right? That's all I know. I know what did I do. That's in the past, but I want to project out the future. And to project out the future, I looked at what analysts were projecting as for the growth in earnings and cash flows of the index. The S&P 500 is the most tracked and followed index in the world. So there are analysts out there whose job it is to forecast growth in earnings in the index, and they were projecting a growth rate of about 4% in the index. I think I'm almost here, because here's what I did. I took the cash flows in the most recent 12 months. I grew it at about 4% to get expected cash flows. Once I get the expected cash flows, I have one final loose end to tie up. Unlike a bond which has a finite maturity, stocks can give you cash flows forever. So the way I brought that in was after year 5, I said the cash flows will continue to be delivered, growing at the same rate as the economy. And here I'm going to make an assumption you're going to see me make repeatedly. I set that growth rate after year 5 to my risk-free rate. Remember we talked about risk-free rates being proxies for inflation and real growth? I'm essentially taking the risk-free rate. So I have cash flows the next 5 years. Cash flows beyond year 5 growing at 1.92%. I know what you paid for the stock. So take a look at that equation. There's what you paid. Those are my expected cash flows in the next 5 years. And that's the value of cash flows beyond year 5. The only unknown is the discount rate, right? It's a little messier than doing a yield to maturity. It requires that you use the solver or goal-seek function in Excel. I solved for that. And I got an answer of 7.12%. You're saying, what does that even tell me? At the start of 2020, I don't care what you hoped you would make, what you prayed you would make, what you thought you would make. Given what you paid for stocks, you can expect to make a 7.12% expected return. The T-bond rate was 1.92%. You're making a premium of 5.2%. This is exactly the game we played, right? $1 asks you how much would you pay. I'm backing out from what you're paying, what the equity risk premium is. It's an implied equity risk premium, and it is constantly in motion. It's changing. While we're sitting here, the implied equity risk premium is changing for the US. It might not be changing much, but we could be sitting in an hour, the market's down 15%. Premiums change all the time, and this is like a measure that captures those changes. That was at the start of 2020, and I went to sleep comfortably for January 2020. That was my equity risk premium. I didn't know what was coming in February, and nobody did. At least none of the people in this room, otherwise we have a conspiracy theory going on. I don't want to turn you in to the conspiracy theorists, but we were innocent in terms of what was coming. And then, of course, on February 14th of 2020, the premium was still around 4 point something, the 5 point something percent I'd computed. On February 14, 2020, if you remember, the Italian government announced that they'd found, up till then, COVID was on cruise ships in China. Right? It was out there. If you're not going to go on a cruise ship and you're not going to China, who cares? And then on February 14, 2020, the Italian government releases a news story that there are a couple of hundred Italians who'd never been on a cruise ship or to China who had COVID. And we woke up to a nightmare. And the nightmare was not just that you'd catch COVID, the entire global economy started shutting down. So between February 14th and March 23rd, are you getting more scared about the future? Everybody was. I don't know whether you remember what it felt like. You were probably still, freshman at NYU. You're saying, will I ever finish my degree? Is there any point to finishing the degree? I might die any day. I'll just not skip preparing for the class. We were all filled with more uncertainty. If you had a job, you didn't know whether you'd go back to the job. Of course we were scared. And what happens when you're scared? You start to charge a higher price for risk. Take a look at what happened to the equity risk premium. In 6 weeks, the implied equity risk premium for the US went from little under 5% to 8%. That's what happens during crisis. Crash flows don't change in 6 weeks, but the worry you have shows up as a higher price for risk. Yes?
If one man makes 100 yield is going up, that means the price is
going down. Yeah, so during that 6 week period, guess what the S&P 500 did? It lost 35% of its value. Remember, this was during a class, right? People picked companies to value at the end of January if they were on top of it, early February if they were late, and then 6 weeks later the company had lost 50%. Their money-making companies all became money-losing companies. God help with that, but nothing you could do about it. But in 6 weeks, the price of risk doubled. And the driver was stock prices dropping. Now, on Monday I talked about Chinese equities losing, 35% of their value in the last month. Implied equity risk premium in China just shot up by about a couple of percent just in the last 30 to 35 days. We can talk about what's driving it, where is that fear coming from, but clearly something is spooking the market. So implied equity risk premium peaked. What was different about 2020? I've done this every big market crisis. I did this in 2008. I don't remember that. I'll show you that page. I did the same thing. I did between September 12th of 2008, December 31st. During every crisis, I start computing the implied equity risk premium on a daily basis. Just to keep my head straight, because otherwise you're going to freak out. You listen to everybody, they're panicking. This gives you some mooring on this is what's happening to the market. The difference between 2020 and 2008. In 2008, equity risk premiums did pretty much what this premium did over a 3-month period between September 12th and December 31st. They went from 4.8% to 8%. But in 2008, it took almost 4 years for them to come back down to where they were before that crisis. What was different about 2020, and we can talk about what it is about 2020 that made it a unique crisis, is by September, take a look at what had happened to the US equity risk premium. It was back down to where it was on February 14th. But you can see the price of risk changing on a daily basis. So the advantage of implied premiums is you can constantly monitor what that number looks like. Start of 2023. The start of 2024. The index was at this was just 6 weeks ago. Okay? 4770. I did exactly what I did in 2020. Took the dividends and buybacks from the last 12 months. Notice how much of US company cash flows come from buybacks. 2/3 of the cash flows at US companies now come from buybacks. Only 1/3 come from dividends. And then I projected out the cash flows. And at the start of 2024, the internal rate of return, the implied equity risk premium, which I'm going to use to compute the implied equity risk premium, was about 8.5%. At the start of 2024, US stocks are being priced to earn an expected return of 8.5%. And if you compare that to the T-bond rate, 3.88%, that difference, 4.60%, was my implied equity risk premium for January. If you did the, if you looked at my Tesla valuation, which was January 20-something, 21st, guess what you would see as my equity risk premium for the US? 4.6%. We'll check out my NVIDIA valuation that's going to come out in a couple of days. That implied equity risk premium is going to be 4.5%. You say, what happened? I compute this at the start of every month. And for every company I valued during that month, that becomes my base premium. It allows me to keep up. Because that means if I have something like 2020 happen, I'm not stuck with a premium from the start of the year because the number can shift under me. So it's an internal rate of return computed. So think of it as a yield to maturity for stocks. That's what it is. Using dividends and buybacks as replacement for coupons, using the level of the index as a replacement for the bond price, and solving for your IRR and using it to come up with the risk premium. Any questions on implied equity risk premiums? Yes?
So the decrease in the S&P 500, was that only because the people saw the price of risk was higher?
We never know, right? When something happens that catastrophic. If I ask you, why are Chinese stocks down 35% over the last 30 days? All we observe are people acting. They're selling. You say, why are they selling? It's a mix of things. Some of them might be selling because of real fear. Some of them might be selling because they see other people afraid. And some of them might be selling because they see other people afraid of other people. This is getting layers away. But that's the nature of crowds, is when people get scared, everybody rushes for the exit doors. So there might be some originating factor. There's usually some fundamental. With COVID, what was the fundamental that was scaring people? The economy had shut down. We didn't know when it would open back up and what it would look like when it opened back up. I mean, people forget how much uncertainty there was about what the economy... In fact, this was like turning off a gigantic machine which had never been turned off in its life before and said, please God, when I turn it back, let it turn back on. Nobody had any... So that was the COVID. In 2008, what was driving the fear? Banks getting into trouble. If banks get into trouble, it's going to have a spillover effect. Every big crisis has an originating problem, but then that originating problem kind of spins out of control. People get scared, and that fear feeds on itself. Yeah. Yes?
How do you get the growth rate? Like, how do you know that's live? Because, like, after the pandemic hit,
In fact, of all the numbers, that's a good question. The way I get the growth rate is by looking at analysts' forecast of earnings. That's updated once every week. Okay? But you are right. Analysts, when they get scared often stop updating properly. So there was a period for about 3 or 4 weeks where they kind of threw up their hands and said, I don't know what's going to happen. They left the earnings. Of all the numbers, that is the stalest number here because you're not getting the daily update. Every other number is updated every minute of every day. So that's the weakest link here. Is there a standard error around that estimate? Absolutely. So if you ask me, is that my equity risk premium 4.6%? Yes, but the standard error in that number is probably plus or minus 0.2%. But I'll take that, right? What is the standard error in my historical risk premium? Plus or minus 2%, not 0.2%. So there is that noise in the growth number that is going to cause this equity risk premium to be off sometimes. Right? And that's okay as long as you can live with that little bit of noise. So I've computed this number live for the last 30 years, starting like 93 is when I started. But I was able to go back and retroactively do it from 1960 without using any of the benefit of hindsight. You know what I mean by that? I computed the 1960 premium without looking at, because it's not fair to bring in what happens afterwards. You got to act like you were in December 31st. So this is a page of what the implied equity risk premium has looked like for US equities going back all the way to 1960. This graph tells you the story of US stocks for the last 64 years. Let's play it out. 1960s, what do you notice about the implied equity risk premium? Nice, stable, 3.5%. The US economy was the global economy. The US equity markets basically ran the world. Incredibly stable, mean reverting time for US equities. That was the 1960s. 1970s, first, notice that something's happening, right? The equity risk premium is jumping. We talked about precipitating factors. This was not a short crisis. This was an entire decade where premiums went up and stayed up. What was the precipitating factor for the rise in US equity risk premiums in the 70s?
Is that the oil crisis?
The oil, but remember the oil crisis played out around the world. This didn't happen in every market. This was US specific. The oil crisis in the US created inflation, and inflation historically has been deadly for equities. Okay. Higher inflation, people are worried about where will the inflation go. We've actually saw this play out in 2022. Look at how terrified people got. 1978, the implied equity risk premium in the US hits 6.5%. I still remember the Dow was at 750. There were 3 numbers in the Dow. What's it now? Like 38,000, 39,000? 750. Business Week had a cover article on "Are Stocks Dead?" which should be an indication when big business periodicals say "Are stocks dead?" That's the time you should load up on stocks. Because that was the start of one of the great bull markets of all time. But let's take a look at what happened for the next 20 years. There are blips either way, but the premium is going from 6.5% and it's decreasing. Remember, when premiums are decreasing, stock prices are rising. In fact, in the 1990s, at the end of 99, the implied equity risk premium in the US was down to 2%. Let me try an experiment on you. What's the T-bond rate right now? About 4%? Would you be willing to put all your money in equities if I said your expected return, not guaranteed, expected return was 6%? How many of you would put your money in stocks? Don't worry, there's no wrong answer. If you put your money, that's fine. One person in this room. And that person is the least risk-averse person in the room or the most risk-averse person? Least risk-averse people. Most of you are saying 6%, that's not high enough. That's 2% more than the T-bond rate. If I can make 4% guaranteed, I need more than 6% on stocks. And I could do a little survey. How many of you would accept 8, 10? There's a point at which your hand will go up. But at the end of 99, this was the implied equity risk premium of the market. That was the peak of the dot-com boom, and people were talking about how there would never be a recession again. I'm serious. They said, we're in this new age. Recessions won't happen here. And of course, there's the dot-com bust. Implied equity risk premiums pop back up to around 4%. Stay around 4% for about 5 years, and then you get the 2008 crisis. And since 2008, equity risk premiums globally have stayed elevated and more volatile. Welcome to globalization. You see why globalization pushes up and makes equity risk premiums more volatile? Everybody's problem is everybody else's problem. That's what surprises me about the Chinese equity market meltdown is how can the second largest equity market in the world have this much trouble without spilling over? Because that's not been the case for the last 15 years. Until 2008, I used to compute the equity risk premium once every year and use it all year. And my defense was, we're in a mature market. Mature markets, equity risk premiums don't change that much. It's almost like the gods are waiting for you to say that, because that's when the 2008 crisis hit. And since September of 2008, I've been updating those implied equity risk premiums every month. So February number is up on my, if you go to the home page for my web page, it's demodern.com front page, you'll see the updated, the March number will come up, the April number. I won't push you to use the May number because that might be pushing it too close in your project, but try to update the equity risk premiums as you go through. It's a base number. Everything else gets updated for every other country. Because remember, all the other countries build off this base. Okay. Now, the other thing you can get out of this graph is an answer to a question that you will, I get asked this all the time, maybe you will too at some point in time. What do you think about stocks? Do you think they're going to go up? Are we in a bubble? You're saying, how would computing an expected return and an equity risk premium allow me to answer that question? What's the question that you're being asked? Are stocks too high or low? Is 4.6% a sufficient equity risk premium, right? If you say it's too low, as in 1999, you're saying stocks are too high, they have to correct. Any statement you make about markets can be translated into a statement about the equity risk premium. If you tell me this market is overvalued, you're telling me the equity risk premium is too low. It's got to go up. If you tell me the market is undervalued, you're telling me the equity risk premium is too high. So you think 4.6% is a higher or low number? The only way to look at that is to look at through the lens of history. So in this graph, I've looked at the T-bond rate and the equity risk premium over time. And I want you to take you back 2 years to the start of 2022. Start of 2022, the expected return on stocks was 5.75%. That's the lowest expected return I've computed in the 64 years that I've been computing the expected return, the IRR. You say, why would I settle for 5.75% on stocks? Why were people settling for 5.75%? What's the alternative in investing in stocks? You invest in T-bonds, and the T-bond rate was 1.5%. The longest time on the street, there was this acronym called TINA. There is no alternative. So basically, if you ask people, why are you paying so much for stocks? The answer is, where am I going to go? T-bills pay me nothing. T-bonds are paying me 1.5%. And that was the answer you'd have got in the start of 2022, 5.75%. I know it's lowest in history, but my alternative is to make 1.5%. See how much that game has changed over the last 2 years? Now, in fact, in 2022 alone, in 1 year, that expected return went from 5.75% to almost 9%. That's the biggest, and 9% plus actually. It was 5.94% equity risk premium on a risk-free rate of 3.88%. In 1 year, the expected return jumped almost 4%. That's scary because if you think about pushing up your required return, the price has to go down to reflect that. 2022 was an awful year for stocks. This year, we're starting at 8.5% in January. I think at the start of February, that had dropped to 8.3%, 8.35%. I'm okay with 8%, but if that number starts to go to 7, 6.5, 5, you're starting to worry. Is this enough? Is there a correction coming? That looks too low. So this then becomes your barometer for what you think about the overall market. I'm not going to ask you for your market views. I'm going to ask you to value individual companies, but the equity risk premium gives you a sense of where the market is. So the equity risk premium is the price of risk in the equity market. When people get scared, they push up the equity risk premium. In the bond market, there's a price of risk as well. It's called the default spread. So when people get scared, they push up the default spreads across the board. When people get feeling good, they push down the default spreads. Do you think the same people are in both markets? Most of the time, if people are scared in one market, they tend to be scared in the other market as well. So in this graph, here's what I did. I took the equity risk premium, that's a red line, and I graphed it against the default spread on a BAA rated bond. I picked one rating, so the rating is not changing, but the default spread is. I'll start with the good news. Most of the time, the two move together. Why? Because people get scared, they get scared. But there have been two periods in the last 65 years where the two have moved in opposite directions and there have been consequences. The first is in the late 90s. Late 90s, if you take a look at the equity risk premium, it drops and drops and drops. The default spread stays pretty elevated. In fact, in 99, when the equity risk premium hit 2%, the default spread on a BAA rated bond, which is a pretty safe bond, that's an investment grade bond, was also 2%. So the question I was asking, would you rather buy that bond or buy stocks? You say, that's a no-brainer, I'd buy the bond. A lot of people still ended up buying stocks. Question. Yeah. So at the end of 99, something weird had happened. And of course, the correction there was stocks had become overvalued, they corrected, and you got through. Then you get to 2001 and 2002, a different problem opens up. The equity risk premium stays high, but default spreads start to drop off. You know what caused that? After 9/11, Alan Greenspan, who was the chair of the Fed then, said, I will not allow the US economy, either, the hubris of central bankers, I will not allow the US economy to go into recession. And for 3 or 4 years, the bond market was pumped up by money coming in from the Fed. It pushed down default spreads. You push down default spreads, what are you doing? You're lending money to people with bad credit risk at too low a rate. And what happens eventually? The thing blows up. That was 2008. Now, what I'm trying to say is most of the time, the reason I track these numbers is most of the time when one goes up, the other goes up, 2023, both numbers decrease, so I'm okay. But I'm looking for, am I approaching another disconnect between the two markets? Because historically, when you see disconnects, something bad is going to happen eventually when the two markets start to disconnect from each other. Okay? So equity risk means price of risk in the equity market, default spreads is the price of risk in the bond market. So that's the two big financial asset classes. Question? 1978. Yeah, that was the start of Paul Volcker came in as the chair of the Fed to fight inflation. It was a year in which stocks started to recover, but it took a lot longer for it to show up in stocks than it did in bonds. So basically, you're seeing that play out. But you're going to see individually, as you look for stretches where the two move in opposite directions, because that's really what's going to trigger that disconnect. So we talked about the two big financial assets, right? Stocks and bonds. What's the asset class that is almost as big as those two, but we don't talk about very often? Sorry? Derivatives is not even a market, right? It lives off, it sucks up from an underlying stock. Real estate, right? The real estate market is huge, but we don't talk about it mostly because it's not traded. There are REITs and real estate companies, but most of real estate is not traded. It's held as residential real estate. Many people's portfolios, remember the biggest investment they have in their portfolio is their house, right? Is there a price of risk in the real estate market? Do any of you work in real estate or a background in real estate? No? You know what a cap rate is in real estate? What's a cap rate?
It's like the percent that you get every single year.
Oh, you hope to get. Cap rate is what real estate developers use to decide how much to pay for a building. So if you have rental income of $1 million and you have a cap rate of 8%, you'll pay $12.5 million for the building. Basically 8%. So basically you're trying to get the $1 million back. A cap rate is like a cost of equity that real estate investors require. So when they get scared, what happens? The cap rate will tend to go up. You'll pay less for the same building. So I decided to bring that into the picture as well. So think of this as a picture of three markets. The red is the equity market. The black is the default spread, which you saw in the previous one. The green is the risk premium in the real estate market. And it looks very strange. Prior to the 1990s, notice the risk premium is negative. You're saying, why would I do that? Now, when I learned investing, I was told I should invest in real estate in addition to financial assets. You know what the selling point was? That real estate moves in a different way than financial assets. If you own stocks and bonds, it's good to own real estate because real estate has a mind of its own. And in the 1970s, this played out, right? Stocks went down, bonds went down. Real estate was the only asset class that went up because it held its own against inflation. When you have an asset class that insures against risk by reducing overall risk, you know what you'll do? You'll accept a return much lower than the risk-free rate to be in it because it offers you insurance, because much of your assets are financial assets. That seems to hold until you get to the early 90s. And then something weird happens. Real estate starts to behave like stocks and bonds. Something's changed in the real estate market. What has changed over the last 30 years in real estate to make it less of that insurance asset class you had in the much of the 20th century to make it behave more like stocks and bonds now? Yeah, but that by itself shouldn't, no, it shouldn't alter the asset class overall. Have you heard of the name Lou Ranieri? What did Lou Ranieri create? He worked at Solomon. He created the very first mortgage-backed securities. He securitized real estate. You see where this is going, right? As real estate has become securitized, that's good, right? You can now trade real estate, but there seems to be one big negative. When you securitize something, it starts to behave like a financial asset. So if you look at the last 30 years, you see that when stocks have and this is how it's going to play out. If stocks have a bad year, and you're an investor, you look at your stock portfolio, it's down 25%. Your stomach drops. You look at your bond portfolio, it's down 15%. And then you look at your real estate, it's also down 25%. They all seem to have bad years together and good years together. It does mean that diversification has become a much more difficult exercise because owning a house doesn't give you the insulation it used to, and the risk premium picture kind of brings that home. So the price of risk is what we're trying to measure. It's going to change all the time. It might be correlated across markets. I keep this graph live every year just because I want to see how the markets are moving, whether they're moving in sync, whether they're moving in different directions. If they're moving in different directions, why are they moving in different directions? Because it's the biggest asset class comparison that I can do. Any questions on implied equity risk premiums? So does everybody understand the mechanics of what I do, right? Basically, I compute a yield to maturity for stocks, and I recompute it every month. And that number can go down, can go up. And most investment banks and consulting firms still use historical premiums. And a historical premium doesn't change, right? You could be in the biggest crisis, but you're looking at a 100-year history. The 100-year history is the 100-year history. But when I have this argument with investment banks that are stuck on it, I'll tell you the argument they give me as a counter, and you tell me what you think about it. Let's say the implied equity risk premium is 4.6%. And the historical premium is 8.3%. They pick the stocks versus T-bills, and they say 8.3%. First, if I am valuing stocks with an 8.3% premium, I'm pushing up my cost of equity for every company. So here's the defense investment banks give. They say, look, it's not important that the premium is right or wrong, as long as we all use the same number. So if every equity research analyst in your department uses 8.3% as their equity risk premium, and they're doing true intrinsic valuation, what's every equity research analyst going to find on every company that they value? Everything's overvalued. And how long do you think you'll last as an equity research analyst if you put a sell recommendation on everything? So you know what they do? They screw up with the numbers. They play with the growth rate. They play with the cash flows. They destroy the entire basis for discounted cash flow valuation because you start with the wrong risk premium. You're going to come up with very strange numbers. So the reason I push you to stay current is not because the market is right, but because we're price takers in individual companies. If you want to make a market judgment, go ahead. But in individual companies, you want to stick as close as you can to the current implied premium, because if you don't, your valuation is a joint effect of two things: what you think about the company and what you think about the market. And if you mix the two up, I have no idea which is driving your buy or sell recommendation. So look at your equity risk premium, keep track with the changes over time, because you should be reflecting the world you're in when you value the companies, rather than 1928 through 2020 or whatever the historical time period you're looking at. At the start of every year, but so it's almost time for me to work on this, I do a paper on equity risk premiums. So I look at historical premiums, survey premiums, implied premiums, It's 120 pages of boredom, but you know, I do it every year just to keep it updated. And at the end of the paper, I ask a question, right? Which is, why do we use equity risk premiums? Because we think they predict the future. So good equity risk premium will be a better predictor of the future. So at the end of the paper, I have these 5 or 6 different ways of estimating equity risk premium. Historical, implied, other method. And then I look at the correlation of the premium I get with the actual returns I get on stocks over the next 10 years. So if you have a good risk premium, you need a positive or a negative correlation there. What would you like? You want a positive high number. You want to be a perfect. So if you have a good equity risk premium, you should be predicting what the returns will be for the future. So first, you want a positive correlation, and you want as high a number as possible. This is through 2022. I'll have to update this for 2023 numbers. So if you look across with the actual return in the next 5 years, okay, what's the best way of estimating? Remember, the higher the number and the more positive, the better. Using the current implied premium gives you the best estimate of what the actual returns will be over the next 5 years, the next 10 years. What's the worst way to estimate equity risk premiums? I mean, this is almost perverse, right? When you use historical risk premiums, you're actually going in the wrong direction. You're using a high number when you should be using a low number, and a low number when you should be using a high number. And this is the way people estimate equity risk premiums still, is by looking at historical risk premiums. So you don't like the theory, fine. But from a pragmatic standpoint, if your job is to forecast the future, using historical risk premiums is pushing you in the wrong direction. So it's about trying to get the best estimate of your cost of equity and the hurdle rate. And I think using an implied premium will get you there much better than any of the alternatives. Now, one final bonus from using implied premiums. Remember when I talked about Vietnam, I said you cannot compute a historical risk premium. What's the reason for that? There's no historical data. Can I compute an implied premium for Vietnam? Let's start with the inputs. You tell me whether I can get them. Can I get the level of the index? Yeah. Can I get dividends and buybacks from last year? Last year. Can I get expected? It's a little trickier, right? Because the Vietnamese index doesn't have 100 analysts tracking it and projecting it. But if I bent the rules and came up with it, I could get expected cash flows. And if I can do that, I'm almost home, right? I can compute an IRR based on the level of the index and the cash flows. Subtract out the risk-free rate, I have an implied equity risk premium. In 2007, I tried this for the Sensex, the Indian equity index. The index was at 15,446. The dividend yield on the index was 3.05%. You're saying, why aren't you looking at buybacks? In 2007, Indian companies didn't buy back stock. It was only dividends. Their expected growth rate was 14%, and this was tricky for me. I could not get an analyst forecast for the entire index. I had to go company by company looking for forecasted growth rate. And I missed a few companies. There weren't projected growth rates. So it's sloppy. I'm going to take what I can get, 14% growth rate. And the risk-free rate in Indian rupees at that time was 6.76%. It looks very much like the S&P 500, right? There's the level of the index. There are my expected cash flows, dividends. And there's my cash flows beyond year 5. I solve for R. The internal rate of return was 11.18%. What does that mean? In 2007, if you bought Indian equities, I don't care what you hoped you would make or prayed you would make an expected return given what the index was at of 11.18%. You subtract out the risk-free rate, the implied equity risk premium is 4.42%. India and China have always been troublesome markets to compute equity risk premiums in, for a simple reason. Now, the way I compute implied equity risk premiums for the rest of the world is I start with the US premium and I add on these extra numbers. Implicit there is the assumption that I can move my money around as an investor. You know what I mean by that? If you have a risky market and the premium is too low, what do? I take the money out of the market and I move it to a safer market. Indian and Chinese investors have basically been penned into domestic markets. They have escape hatches, but the escape hatches have been limited. Indian investors, for instance, it used to be they could not invest in foreign stocks. They could invest only in Indian stocks. Do you see what this can do to your equity risk premium, right? If you're a domestic investor and you think the Indian equity risk premium is too low, let's say it's 4.42%. At the same time, the US equity risk premium is 4.6%. You're saying, why would I invest in Indian stocks with a lower premium? Because you have no choice. You say, what if it goes to 4? What if it goes to 3? At some point, you know what you're going to do. Even though you can't invest in foreign equities, you pull your money out of stocks and you move it somewhere else. Historically in India, this used to be gold. You know what? This is exactly why it's so unhealthy to keep money pegged into a domestic market. You're going to move bubbles around, right? Because the money's got to go somewhere. You've penned it up. You say you can't go out. When the correction hits, everybody's heading for the exits, but they're not putting it into other financial assets. They're looking for things to put it in. So when you look at an equity risk premium for a market, one of the things you could do when you do this domestic is you can see if the market's gotten out of sync. The Indian equity market is one of the most expensive markets in the world today. Especially after the Chinese market correction, it is probably the most expensive market. It's being driven by an India story. It's a story that's picked up legs. The India story has legs, but notwithstanding all the good stuff that will come out of it, Indian stocks are too high for me as an investor who has choices. But if you're a domestic Indian investor, you say, should I buy Asian Paints, which is a very good company. But it's a company that you're paying 55 times earnings for. It's a mature company. I say, I'm not going to buy it. It's not good for me because I can buy a better, I can get a better trade-off by buying a US stock or a German stock. But if the only thing you can do is pick across Indian stocks, you're almost forced to play the pricing game. Remember we talked about the pricing game? You say, look, I can't do intrinsic valuation. Everything looks overvalued to me. I'm going to pick the least expensive of these stocks. And that's exactly what happens when you pen people up into a market. One final thing, and this is a table I update once every year, where I take all stocks listed all over the world and I put them into 2 buckets, and I have to make some judgment calls. A developed market bucket and an emerging market bucket. Developed market bucket includes most of the US, Canada, Singapore, a few, the few of the Western European markets, not the Southern Europe and Northern European markets. And the emerging markets includes everybody else. And I do an implied expected return in dollar terms for both groups. You see what I'm trying to compute? Let's go back to 2004. When I do the implied cost of equity, so I'm doing the IRR for all of these companies, the implied cost of equity for developed markets was 7.28%. The implied cost of equity for emerging markets was 10.55%. Why am I charging more for emerging markets? They're riskier. That difference is the premium I'm charging for investing in emerging markets. Take a look at that difference and what happened to it as you go from 2004 to 2012. You see the number drift. There's 2008, a little blip. But by 2012, investors were pricing emerging market equities and developed market equities as if they were interchangeable. And remember the stories, you probably don't, you were too young. The story after 2008 is the line between developed and emerging markets is gone. Emerging markets are starting to look like developed markets like emerging markets. What's the difference? And by 2012, investors were pricing emerging market stocks as if they were developed market stocks and vice versa. I think the story has a kernel of truth. It is true the difference between developed and emerging markets is far smaller now than 30 years ago, even 20 years ago. But it's not gone away, right? We keep getting woken up to the fact that emerging markets have some special risks that are still there. So if you notice what's happened since 2012, you're starting to see the premium come back up, but it's still well below what it was in 2004. So there is still a gap between developed and emerging markets, but it's far smaller than it used to be because there is some truth to the fact that developed markets have a lot of emerging market characteristics to them. Central banks that can't be trusted, political systems that are unstable. And emerging markets have many developed market characteristics, and the difference is narrowing. Yes?
Have any of the original countries listed as emerging become developed over
Yeah, each year I actually make my own judgment. So basically this comes out of my big data set that I do at the start of every year where I take 48,000 publicly traded companies. So the kinds of countries, and sometimes a developed market goes in an emerging market. 2004, Greece was in the developed market group. It was part of the EU. The promise there was they're all part of the EU. They're all equally safe. By 2012, Greece was in the emerging market pile. So basically, the piles keep shifting. And I use the ratings to make that judgment, right? Rather than me sitting there and saying. So I think the cutoff for me for a developed market is A+ or higher is developed, anything below A+. It's kind of it's a bludgeon. I'm doing it across a lot of companies. I don't have the finesse to do it on individual companies. But it's just to get a sense of what are investors paying for developed and emerging market companies. But the reason I'm able to do that is because I have that implied equity risk premium. So to me, it's a versatile tool that I can use. Right? So I intend to actually do the implied equity risk premium for Chinese equities over the last month. I am curious as to what exactly is going on here. I'm curious for selfish reasons because I know the spillover effect is coming, and I have to be ready. I did during Brexit for the FTSE. That the weeks leading up to the Brexit election in 2016. So whenever you see a big election, it'll be a good year this year to do this starting in October for U.S. equities, leading into the election in November, because you're going to see risk and uncertainties build up. The equity risk premium becomes your thermometer for how hot is it getting. Should I be getting worried? Yeah. So let's at least get started on the third. So we've talked about risk-free rates. If I ask you what risk-free rate are you going to use in your valuation? So what's your answer going to be? What risk-free rate are you using in your valuation? You haven't picked a company yet? Or you? I did. Okay. So that's easy, right? So what risk-free rate are you going to use? The bond. T-bond rate, right? So risk-free rate will depend on the currency you're doing your valuation in, not the country, not the company. When I ask you what equity risk premium you're going to use for your company, you're going to get the geographical breakdown of operations and try to get a weighted average, which leaves you with one input that we haven't talked about, which is beta. Okay? I don't know about you, but I was taught betas in a way that still sucked all the economic intuition out of the word. I was asked to run a regression of returns in the stock against returns in the market index. The slope of the line, I was told, was the beta. Every finance textbook starts with that equation. If you don't believe me, open up your finance textbook, there'll be this page. Okay? It's the way in which most analysts estimate betas is by looking at a regression. In fact, most of them don't even use a regression. You ask them, where do betas come from? They'll say it comes from Bloomberg. Because they look it up, right? Let's face it. Once you start working, nobody runs a regression. You look it up. And it's a terrible way to think about betas for three reasons. One is when I run a regression of your stock against the market, is it forward-looking or backward-looking? By definition, it has to be backward-looking because you look at past returns, right? So if your company's changed, the mix of businesses has changed, that beta is no longer the right beta. So it's backward-looking. Second, it's noisy. What does that mean? Remember that standard error I talked about with equity risk premium? I'm going to show you what the standard error is for your beta. And you don't get a number for the beta, you get a range. And third, if I asked you to estimate a beta for Birkenstock in September of 2023, if you haven't looked at your valuation of the week, that's your valuation is Birkenstock. Even if you don't do the valuation read, it's kind of a fun. When's the last time you saw Barbie enter a valuation? And Barbie does affect Birkenstock's value. If you're looking at the Birkenstock valuation, you say, where did you get the beta? If I run a regression, there's no regression to run. There are no past returns. It's a company that's been a privately owned company. I hate regression betas. So let me dig a hole for regression betas, bury them deep, and next session I'll talk about what do we replace it with. So let me start with the first problem I have with the regression betas. They're noisy. They're unreliable. This is actually a regression beta I ran for GoPro. Remember that company? What did it do? Make cameras for overactive sharers, basically. That's what you know. So basically people would strap the camera to their head, take you on a 3-hour hike with them as if you were particularly fascinated by all the pieces of land they were looking at or whatever they were looking at for 3 hours. But for a while it was a huge growth company. Ran a regression and I looked for the beta, and the beta said, you think this is good, I have my beta 1.604. But keep going down to this item that says standard error of the beta, 0.497. If I tell you the regression beta is 1.64 and the standard error is 0.5, do you remember enough statistics to give me a 95% confidence interval on your beta? Plus or minus 2 standard errors. So basically with this regression you can tell me, oh, GoPro's beta anywhere from 0.6 to 2.6. Thank you for letting me know. That was very helpful. It'll allow me to get a really precise valuation. Noisy. You say, what if my beta is really precise? this looks like a magical regression, right? If this is a statistics class, you'd get a gold medal. This was actually a beta page that I printed for Nokia in 2001. So I went to Bloomberg. Nice thing about having a Bloomberg terminal is you find your company, you type in beta, you get this page. This looks amazing. Standard error is 0.03, close to 0. The R squared is like 100%. Why is Nokia's beta so much better than GoPro's beta? More precise. What is it? What do I get to get a beta? I run a regression of returns in the stock against returns on a market index, right? What was the market index I used for GoPro? I didn't ever use it. In fact, you go to Bloomberg, you look up the beta for any US company, it runs it against the S&P 500. So when I asked for a beta for Nokia, it did what Bloomberg does, which is, it's very parochial. The regression was a Nokia against the hex. I'll make a confession. I didn't even know there was an index called the hex. I thought it was a witch's curse until I ran the regression. You know what the hex is? The Helsinki exchange. You say, what the heck is Bloomberg doing? Going to Helsinki. Nokia is a Finnish company. It went to Helsinki, found the Finnish index, and herein lies the problem. I didn't know what was in the hex. So I took a look, and I wish I had not. I think in 2001, Nokia owned Finland. I'm not kidding, it was 80% of the hex. So what do you have here? A regression of Nokia against Nokia, and you're finding out an awful lot of the time the two move together. What did you expect? It's a completely useless regression. You can't trust regression betas when they're noisy. You can't trust them when they look good. And you can get some really absurd results if something strange is going on with the company. Remember I talked about GameStop? Stock goes from 20 to 400. Is that a volatile stock? It goes from 20 to 400 back to 20? I ran a regression beta for GameStop around that period. And what I got as a beta was minus 0.62. What's happening? What do betas measure? They measure how a stock moves relative to the market. When you have a stock that gets caught up in a meme phenomenon, when people are buying it or selling it, it's nothing to do with the market. Guess what you've done? You've broken the correlation between the stock and the market. What you get as a beta means absolutely nothing because of what was happening to the company. One final point, in all of these betas, you'll notice that right below that raw beta, Bloomberg reports an adjusted beta. That sounds adjusted, right? You know the adjusted beta for Bloomberg estimates betas for 40,000 publicly traded companies. For every single one of these companies, the adjusted beta is calculated exactly the same way. And I'm going to go back a couple of pages. Maybe I can, oh, there it is. The old beta pages they actually used to show you how the adjusted beta is computed. Somehow they seem to have taken it out. For every company, Bloomberg computes a beta for the adjusted beta is 0.67 times the raw beta plus 0.33 times 1. What? So if your let's see what will happen. If your raw beta is 1.8, your adjusted beta will become 1.53. Keep track of what's happening. 1.8 becomes 1.53. 1.5 becomes 1.33. 0.6 will become 0.73. What are they doing? They're pushing betas towards 1. What's so magical about 1? It's the average beta. They're trying to be helpful. And your response is, please stop. Because these weights have to be magic weights to work for all 40,000 companies. So I decided to call Bloomberg. This was like 20 years ago. Not the mayor, but the company. You know, it was a little confusing for a few years there. And I wanted to find out, no, why 0.67 and 0.33? They put me in touch with the beta calculation guy at Bloomberg. There is actually a guy at Bloomberg whose life it is to maintain this page. Can you imagine how exciting his life must be? He goes to a cocktail party and says, I'm the beta guy at Bloomberg. Dozens of people gather around for anecdotes. Not. The guy's pathetically grateful to get a call from the outside world. I don't know, but they must keep him locked up in a basement room, feed him through a hole in the wall. And so he says, I'm so glad you called. I have all day to answer your questions. I said, I don't have all day to ask you questions. I was afraid if I hung up the phone too soon, he might do something rash. So after a few minutes of polite conversation, I hit him with a question. Why 0.67 and 0.33? 2 minutes of silence. I can hear papers being rustled, terminals being turned off and on. And then 2 minutes later, he comes back on and says, I don't know, it was here when I got here. I said, what? He said it was hired 3 years ago. It was already here. Don't blame me. I'm saying, I'm not trying to blame you. I just want to know where the number comes from. Next class when we start, I'll tell you where, because I had to do the research to find where the numbers came from. And guess what? They're just as useless after I found out than before. So if you're going to use a Bloomberg beta, at least use the raw beta. It's a number that you can actually use. The adjusted beta just tells you which direction one is. I will see you on Monday.